There are two ways to invest in property. The hard way is to buy a property and wait, maybe for years, hoping it improves in value. The other way is through active investment in development projects, where approvals and subdivision potentially add value to the property. You may think that this kind of investment takes funds and expertise, but that's where CFMG comes in, with our Land and Opportunity Fund. We give you the opportunity to invest in significant development projects with as little as $25,000 using our specific investment criteria. This opportunity also provides diversification across multiple projects. By pooling your funds with those of like-minded investors, you can invest in development projects that are typically out of reach to everyday investors. When you invest, you are investing in the transformation from one large parcel of land into smaller, subdivided residential lots. While our analysts assess and investigate many projects per year, only a select few meet the specific CFMG criteria. Here's how it works. Once you've registered your interest with us, we'll contact you when a project investment opportunity becomes available. We'll send you detailed information in the form of a product disclosure statement, including the project criteria, risks, and returns. If you decide to go ahead, your funds go into a pool used to purchase the land and complete the project. Our experienced team then manages the project through construction, subdivision, and sales, keeping you up to date throughout the entire process. If the project is completed successfully, then you get your initial investment back, plus any profits calculated using a fixed percentage return each year. You can repeat this process as often as you like, reinvesting your initial investment plus any returns into the next project. The CFMG Land and Opportunity Fund is open to all investors. It's a property investment with no agents, no maintenance, and no unpaid rent. You just sit back and relax while the experienced experts run the development for you. Our business holds an Australian financial services licence, so you can be confident that your investment is professionally managed in a regulated environment. So why not give us a call and see how even a small investment can produce returns for you?
Well, Lauren just spoke about the effect of interest rates and borrowing and how you can sort of make that work right now for property. But of course, there's a broader sort of perspective to do with the post-pandemic property outlook. And as we all know, property is a very, very popular asset class among SMSF trustees. So this next session is going to have a look at that. It's going to be presented by Andrew Thomson, who is the General Manager of CFMG Capital. And I wanted to just offer him a congratulations. He told me outside that he'd won a premiership with his AFL team and suffered a personal injury along the way. So go easy on him, but please welcome Andrew to the stage.
Sure what's going on there, but I'll start with an introduction anyway. My name's Andrew Thomson. I am a bit rusty. I haven't had to get up on stage or attend in a conference for about 2 years. Last time it was Lauren and I, we seemed to follow each other. We went around the country for 3 weeks presenting on stage, got back from Perth, and the country went into lockdown, so we may as well spend the last 3 weeks at the pub, but hopefully this time around it's a lot better. I'll be talking about property, what's happened during the pandemic. About me, I started working in banking when I first graduated from uni. Then I moved into development. I sort of fell into development originally. Then spent some time in some startup businesses, but always sort of seemed to find my way back into the development space. Spent some time, don't admit this in public too often, at AMP Capital. But then again, found my way back into the property space where I shall remain until I retire, hopefully not too far away. So property, I guess, is, as I said, as you would have seen on the screen, and as Darren alluded to, it's the largest real asset class in the world, and Australians certainly have an unbridled love affair with property, sometimes to their detriment. But more often than not, it's a positive relationship. Can't quite see. We've got the screen down here. So as anyone that hasn't been living under a rock knows, the pandemic, despite the naysayers at the start of the pandemic that said we were going to have a 35% decline, actually supercharged what looked like a cyclical upswing that was coming anyway. We saw one bad month in our experience. So we were operating during that time. There was a lot of panic in the market and every market. But for us, our lived experience was April 2020 was probably the only bad month we had. So even before the stimulus and the mass rate cuts, we started to see increased market activity in May 2020. And even March 2020, when we first went into lockdown, most of those people that were transacting didn't panic and completed their transactions. So April was that only bad month. There were some unique market forces during that period. So yes, we had 25% growth, as you can see on that top graph on the right. But we also had in excess of 50% growth in some of the premium markets, places like Noosa, Sunshine Coast, Gold Coast, and then also really premium inner city suburbs had what we call the micro markets. They were seeing in excess of 50% growth. And also the outlier was, for obvious reasons, was the sub-regional and regional markets. So people were fleeing to the wide open spaces rather than being locked up in their houses for months. But across the board, we had 25% increases. Also, we'll go into the next slide, but first home buyers, they love an economic crisis. So if you look at the graph there, first home buyer activity just continues to boom in 20. Sorry, did I go back? I got to go back one. So if you look at that graph there, first home buyer activity boomed through 2009 on the back of the back of the GFC, and then you can see the activity again in 2021. And that's mainly because of that economic crisis and the stimulus that comes with that. We also saw during the pandemic market a mass increase in rent, which therefore increased yields, which then led to increased investor demand. So we had first home buyers at one end of the market flooding the market, creating extra demand, as well as interstate investors or just local investors taking that yield play, which normally, most people invest for capital growth in a direct property purchase, but there were some yield advantages in purchasing at that time. And then also during that period for first home buyers, we had, with the increased rents and low rates, it actually, in a very rare occurrence where it actually became in some of those entry-level growth markets, so what we call the mortgage belt, the inner to outer ring suburbs of major capital cities, it actually became more affordable for some families to buy a home than it did to rent. So therefore, their repayments per week were cheaper if they bought a property than it was if they paid their rent every week. That still doesn't get you into the market, generally speaking, because you need a deposit. But during that period with the builder's growth, the builder's grant, a lot of banks were allowing you weren't supposed to, but certainly plenty of people were getting away with it. They were treating their first home buyer's grant on top of their builder's bonus as their entry-level deposit. So a generation of people got into the market that wouldn't have otherwise been able to through that stimulus. So they were able to avoid that deposit challenge, because that's the greatest challenge for the first home buyers out there is not the ability to service their loans, it's the ability to raise that 10% deposit, because while they're raising their deposit and the property keeps going up, they get to the 10% they set out to achieve, and it's suddenly only 7% by the time they get there. Another interesting part about that was record levels of household debt. But debt to asset value remained low. In fact, some RBA data suggested that housing interest payments against your income was at the lowest level since 1999. So housing was never more affordable than it was during that pandemic market. There was also moving on to the post-pandemic activity. we are in what I would call a normal market period. So people like to call things slumps, people like to call things booms. We are allowed to have a normal market. In these normal market periods, who can suffer? Well, it's those people that bought right at 12 o'clock in that property cycle. So if you've leveraged yourself to the eyeballs and bought right at the peak, then the rates start going up and you can't service your debt. You're the only one at risk during those market corrections. There's also, in this post-pandemic market, with the limited growth opportunities, there's also reduced stock on the market. So certainly in my experience in the areas that I live and socialise, there was what we call profit taking. So people who had no intention of actually selling their primary or their primary home started to just think, well, the market's that good. If I was ever going to sell, now's the time to do it. They were putting their house on the market, getting a record price and moving on to either upgrading or downsizing. Those people are not in the market anymore. So that therefore the stock on the market's reduced significantly. There was also in the development space, so developers like us that build new land estates, a little bit of sort of margin chasing, monkey see, monkey do type operation. So you couldn't keep up with the growth. So we would launch a project, we might our budget is to sell 5 blocks per month per project. And during that period, we'd launch a project, put 20 blocks on the market, and all 20 would go on the first day. And the response to that is, well, you've got to lift the price. So you lift the price again, and the next Saturday you'd sell another 20. You lift the price again, next Saturday you'd sell another 20, and you couldn't keep up. There was no reason, there's no real reason for this growth other than just demand outstripping supply by mass margins. So now we're in a more normal market. Developers have got to adjust back to the normal conditions. So we won't be margin chasing. There's also, if you're in a growth market and you're developing, so if I take a block of land in an outer suburb and I'm developing the land, so I start building my roads in March, but I'm not actually settling my blocks till October. If I sell the block in March at March prices, the buyer that buys off me in March gets to buy it at March prices. And the way the market was moving, there was no point in selling stuff in March when you knew you were finishing in October. So you were starting to hold your stock back, get to a point in construction where you needed a drawdown from the bank, so then you'd get your pre-sales in place, so you literally put 15 blocks off the market, sell them in one day, finish the project, and then you'd flood the market with your stock right close to the end of construction, and to that's where you'd boost your margins to the levels unseen before. So going forward, looking at that graph, I'll just see you have to. So you see that dotted line there. So that's where we think without the pandemic, the market was headed anyway. But we've had this mass supercharged boom. And the arrow on the right, they're the people that I'm talking about, that I think people that have bought in that right at that 12 o'clock or in that slide down, they're the only ones in danger. Everyone else that's bought below that line is still, they've done pretty well for themselves getting into the market during that period. Any growth that comes in property now, so you know the naysayers that were saying at the beginning of the pandemic that we're going to have a 30% price correction, they'll be saying now the market's correcting, and they'll be saying that forever, basically. But right now they're probably correct. So the market's not going to be doom and gloom. It's not going to be diving. But any kind of price growth in the property market, certainly in new developments and existing real estate, is going to be milestone driven. So for us as a developer, if we're building a house and land estate or a land estate, any growth that comes will be driven by a milestone. Construction commencement, footpaths go down, road base goes down, construction's completed, ready for settlement. That's the only time, as things become more certain during the development process, that's when you've got the ability to do a little price rise. Because those people buying off the plan on a greenfield estate where at the moment it's just nothing but grass and trees, they're taking the greatest risk in their purchase, therefore they get the cheapest price. And as you drive through the milestones during construction, that's the only opportunity for price growth in development in the coming sort of 12 to 18 months at least. So how do we navigate a situation where we don't see price growth? And for some of you that, not sure if I've got any investors in the room today, but some of you that heard me speak before, developers like us or fund managers like us, we're not driven, certainly we enjoy growth, but we're not driven by growth. We look to create and add value to a property ourselves. So there's little mini cities, regional CBDs, things like that where we can enhance a project. So if you've got, say, for a teacher and a mechanic, and the teacher teaches a local school, their proximity to the CBD is irrelevant. They don't need to go into the CBD. I live 5 kilometres from the CBD and work in the outer ring, and I can't remember the last time I went to the CBD. So proximity to the CBD in the property market is overstated as an important factor in value. And that's becoming far more common now with these mini cities, mini CBDs, and also whether it stays this way, whether it's a permanent shift to the working from home. I'm not sure how sustainable the mass working from home is. Certainly everyone in our office is back in the office, but there are those people that have got used to it for the last 2 years and got no interest in going back to the office. And those businesses will have to make a decision on what they do with their employees, because that's probably going to be the major driver in affecting any kind of regional market. There is a potential for some of those sub-regional markets to suffer a small downturn if those people find they have to return to the office and move closer to their employment. So what I'm talking about is capital growth not being everything. So how do we create value? Property development essentially is renovation on a large scale. So you take an asset, you get a development approval, you do the works, and you create the value through that. So when we look at a project, we're not looking, we can't build a feasibility model on saying, I'm going to buy the X project for $10 million. Right now, if I sold all the blocks, using round numbers, I'd be worth $20 million, but I think there's going to be 30% growth, therefore I'm going to get $25 million. You can't do that. You can't speculate on such a mass level like that. Well, certainly we can't. There are those people out there that do that, but for us, we have 2 different funds. So we have the first mortgage and income fund. So that's exactly as it's described. It's a first mortgage security and it pays an income. And how we use that is 2 different ways. There's one for residual stock. So if we have residual stock on a project, we'll borrow against it for working capital. Now, we've just been through probably the biggest boom of all time, so we don't have any residual stock, no such thing. Bit like leftover wine during the pandemic. So with the first mortgage income fund, we purchase an asset, so let's call it a 10-hectare parcel in the north of Brisbane. We might buy that for $3 million with the expectation that we're going to get a development approval. We'll get a valuation on that site at $3 million, which means as is, where is, no approval in place, no development upside, it's worth $3 million. We'll borrow or raise up to 70% of its value to help us purchase the site for a start, work through the numbers to get our development approval in place. If we're successful in getting the development approval in place, well, naturally that site's now worth a lot more than $3 million, and it moves into our land and opportunity fund. But if it's not, if we don't get, we've only ever had it happen once. If we're unsuccessful in getting development approval, we can just sell the asset back into the market. And as long as the value hasn't gone down by 30% in that period, the investors get paid their capital back, and they've been paid their quarterly distributions anyway. But generally speaking, we'll get the development approval, sell it as a land opportunity fund, and our land opportunity fund is our flagship fund, and that's used for the actual purposes of development. So essentially, the investors in the land opportunity fund are getting a share of the profits from the development of that parcel of land. Now, not every land opportunity fund project comes from the first mortgage and income fund. Sometimes we're able to buy sites subject to a development approval with a development approval, but that's how our first mortgage fund works, and that's how that transitions into our land opportunity fund. So I guess the key point there, and alluding to what Lauren said earlier, we've got skin in the game from day one. We've got skin in the game when we identify the site, we've got skin in the game when we raise the money, and we've got skin in the game also because our business is driven by the profits of that project after we've paid our investors. So we waive our fees, we're not profit taking until the investors have been paid their share of those profits. So driving value in the absence of growth. So I referred to it earlier, so the micro versus the macro markets. If you look at that graph, while we had 25% price growth during that pandemic market, it was 21% in capital cities and 36% in regional markets. And then, as I said, you've got all those little micro ones. So what we found, the most premium suburbs had record growth, regional suburbs had good growth, but then across the board, everyone had 20 plus. So what we like to do is we find a high-performing micro market that has a repeatable model, and we like to stay there. So we've got projects in South East Queensland at the moment, about 9 active ones. In Logan Reserve, for example, we're onto our 5th project in 5 years. So we just keep buying sites either adjacent to us, nearby. We want to operate where we've got the expertise. And the beauty of that is the vendors or the old Farmer Joe that's got 10 hectares he's lived on for 40 years, if he sees that you've been active in that site, you're going to be more likely to be the purchaser, because essentially he's got 20 developers knocking on his door saying, I'll give you X amount of dollars for your land to turn it into a housing estate. And the most competitive part of the development process is securing those sites. But once you get into a region like that and you've done the right thing by 5 vendors in a row, well, the 6th guy will know that you're legit, and you've done the right thing by the bloke that he's been his neighbour for the last 25 years. And that's how you get sort of residual stock going through those processes. So how do we do that or build that revenue or build that value is when we target a project. So we've had a model change. So going back in our business, probably certainly last time I spoke at one of these, we used to pay a fixed return of 12% on every single project we did. Over time, that's now become a project by project return. So it varies from 8.95 up to 11.95. That depends on the size of the project, what its development approval status is, how many blocks we've sold, how long it's going to take. Generally speaking, the longer you're locked up, the higher the return. But under that model of 12%, whether it's 12% or 8.95, we're looking at, we know what we want to make, what we're comfortable making after we've paid investors. And by reducing it from 12 to 8.95, that's opened up a whole new market for us that we used to, we'd assess a site, we'd go, okay, after we've paid 12, we're making X, we can't look at that site. But when we're not paying 12, we're paying 9.95, suddenly it opens up opportunities for us as well. And our investors understand that. So why are we not forecasting growth, or why are we not chasing growth? Essentially what we say every time we assess an opportunity is, does it provide the appropriate return that we're looking for our investors and ourselves if the property prices remain as they are? Now, if the answer is yes, then we start our detailed analysis and we go forward. And at the moment, we'd add a question. We would stress test that feasibility. So we would do downside testing, because there's no beating around the bush. I think every property person out there will be telling you, oh, no, we've got exponential growth for life. Well, we're showing that's not the case. But you don't need, certainly for our fund or developers, they don't need exponential growth because we're adding value in the development process. So that's how we create that value in a flat market or a normal market. And as I alluded to earlier, like we are allowed to have a normal market. It'd be nice to have a normal market for a few years. So do we target growth? Probably labouring the point a bit here. Yeah, of course we do. But growth's the cream on top. We want to create our own value. So going back to the Land Opportunity Fund I referred to earlier, got to talk about our products. That's what we're here for. So the Land Opportunity Fund's our flagship. It's been around since inception of the business. You've got an ability to diversify across projects, so it's a project-by-project investment. So if you've got your own expert opinion that you think a project in southwest Melbourne's better than a project in southeast Queensland, you can choose to be in that one over the other one, and it just depends what offers we've got in place at the time. Every project's issued under a supplementary PDS. We do hold our own AFSL, and we are governed accordingly. And that's our development fund. So the second one is our First Mortgage Income Fund, which I described earlier. So as described, holds a first mortgage, pays an income. We launched this product in response to pretty much demand from our own investors over a long period of time. We had a lot of investors moving into pension phase, a lot of investors seeking income, liked our product, liked our business, loyal to our business, but we couldn't pay them an income. And you can't, there are funds out there that do it, but you can't pay an income from development. So we had pressure to turn our Land Opportunity Fund into a quarterly distribution, but there is no income in development until you complete the development. So if there's no security and there's no income and you're paying an income, you're nothing short of a Ponzi scheme. So the only way you can pay an income is with the first mortgage security over the asset. Because if you're using it for development purposes with no mortgage security, I'm not sure where the income comes from. So who we are, we have been operating, well, I've been there 11 years. Business started in 2008, which was really, really good timing. But the fact that we managed to get through those cycles is a feather in the cap. We had, I think when I joined in about 2012, there was 8 of us. We had 15 in 2020. And then we, unlike others, we certainly saw the start of that pandemic. We saw that trend. I say we had one bad month, and then before even the rates started cutting and the stimulus started, we could see the activity building. And the beauty of that at the time was people were shedding staff, so we were able to pick up a lot of really good staff that we otherwise wouldn't have been able to. So we doubled our head count in that 2-year period. We've also got a massive weighting to self-managed super funds. We didn't design the product that way, but it became obvious after time that it's a bigger source of investable cash for most people. We have raised over $100 million of investor capital deployed across active and completed projects. And I'd say those numbers are slightly out of date. I think probably we've ticked over 90% of our capital comes from self-managed super funds. And I also alluded to before, we have a 91% reinvestment rate for our investors. However, that's actually, being brutally honest, that's dropped a little bit. And that's as a result of we were at that 12% for 7-8 years straight. A couple of those people liked the 12%, didn't like the 9.85s and the 10.25s, and they went chasing yield elsewhere, as they're entitled to do. The average rate of return was 12% because it was 12% all the time. Since then, it's now dropped to 11.1. But I guess the key point is we've delivered the forecast rate of return or the targeted return on 100% of the projects we've ever delivered, with a clean track record in that regard. The First Mortgage Income Fund, it is only 18 months old, but in that time, we've already raised over $10 million with an average return of 6.39%. So just our recent history, even just from March to June this year, we returned over $20 million of capital to our investors plus interest. And you see down the bottom there, if it's legible, we started the First Mortgage Income Fund, some of those investment dates, August. They got out as soon as Feb 22, got their distributions, and we've maintained that 100% track record through the Land Opportunity Fund. I've got a 5-minute warning, so I won't. I did have a video that more from our marketing team. They like to put our testimonial videos in, but I don't think you guys need to hear our investors tell you how good we are, so we'll skip that. if I can skip it. Probably should have disclaimed at the start, but I haven't given any advice, so that's fine. But more just want to throw to the people at home or the people in the room if you've got any questions. Yeah. Righto. Everyone can see that, yep. So I think I covered that, but yeah, 100%. So we were putting blocks on the market, increasing prices every week, almost every day, and we are now expecting prices to flatline and in some cases fall. Yes, that's correct. Certainly, even our projects, to give an example, we have projects that we bought in 2019, we acquired the site. We didn't start selling till sort of the middle of 2020, but through 2020 and 2021, we might have, in our feasibility model, we might have said, okay, we need to make our profit and return the money to investors, we need to sell every block for 200,000. By the late 2021, we were selling those blocks for 320. So good for us, good for everyone, but if now they're worth 300, down from 320 or 280, that's fine. If we need to go back and meet the market, we will, because we're still 80 above what our feasibility stated. So referring to that graph earlier where the supercharged boom created this triangle in the middle, that linear growth was coming anyway. We were expecting a cyclical upswing in those markets. But, you know, I think anyone that gets up on stage and tells you that the boom's going to be exponential and continue, they're probably telling you fibs, or they're a better judge than I. But we think it's going to be flat. There will be some price regression in certain areas, particularly those areas that saw 50, 60% upswing in 12 months. I'm not sure that's particularly sustainable. So definitely we think prices will flatline. Good. Oh, yeah.
Recently in the media, there's been some high sort of important builders that have gone under.
Yep.
The ASX. How do you see that impacting developers such as yourself? Is that more of an opportunity, or have you reevaluated how you go about targeting certain properties?
So with that, it's certainly, so builders are under pressure. So I had some stuff about that in here, but I forgot to say it. But we don't build anything. So we develop the land. So we build roads, sewers, stormwaters. We don't actually build the homes. So that doesn't cause any pressure for us, I suppose. But it's just impacting the buyers of our land. So they might have gone to build, you know, people have been saying Metricon are going bust for 6 months. They're still there, but I wouldn't be putting a deposit down with them tomorrow. As a result, you know, you can't stop what the media says, but actual builders don't impact us directly, but it does impact our third-party buyers of our land. And that's just all about doing due diligence about which builders are safe and which are not, which are probably few and far between at the moment. But that'll come off. It's tradies scalping prices, supply chain issues due to COVID, and also the exponential boom that we're probably building 10 times as many houses than anyone forecast in that 18 months originally. Thank you.
Well, thanks very much for that session, Andrew. And if you do have any other questions, including the people online, please submit them via the live Q&A app. And for the people in the room, please go and visit Andrew during the break, and I'm sure he'll be able to answer any of the questions that you throw at him there.